last week. Close that out and get that out of there. And let's look into it. So we'll spend about an hour and 15 minutes, just as usual. So let me first tell you guys what I believe has a higher degree of being tested on the exam. And let's see this. Give me another second here. There we go. Don't mess around as far as like Social Security and the different retirement plans. You got to know your stuff when it comes to Social Security. And so I'm talking all things Social Security. You're going to brush up on your aim and how that's calculated. You don't have to know that back and forth, but you want to know the average index monthly earnings, kind of have an idea of how we get there and why, because the aim gives us our primary insurance amount, and all benefits for Social Security, when we're talking about the insured person, are going to be based off of that primary insurance amount. All right, you're the family maximum based off of the primary insurance amount. Full retirement age, what you want to have in your mind, and definitely know, and some of you know this from your practice, only, let's not say bad, but only, negative consequences if you take your benefits prior to full retirement age. Once you hit your full retirement age, you're clear. There is no reduction in your benefit. There is no temporary reduction in your benefits if you take your benefits at full retirement age, as there are when you take it at before that point. You want to know that you're going to build up, and you're going to get credits for delaying taking your Social Security past the age of 67. Now, where do I think that they're going to probably hit you on the exam? It's going to be around these divorced spouses, and then these, I should have probably said deceased. Let's put deceased and divorced spousal rules. And they might ask you about like a Social Security strategy. We got a husband and wife. The guy is older, he passes away first. Wife is still working. Does she start taking her benefits at age 60, which is the earliest that she can take it? Does she wait until she's 67? If she goes before age 67 or her full retirement age, what's going to be her reduction in benefit? Those type of things you'll want to know about, right? We're consistently, most, or if not all of our topics, going to build that fundamental understanding, and then we're going to have to apply it on the exam. And once you fully understand that that's how likely you're going to be tested, you'll start looking at the questions in a different way. I think that you'll start reading into the questions a little bit more and say, all right, well, this is the angle that these guys are taking with this, and that's okay. If they take a certain angle, you know how to deal with that. Now, we want to definitely know the survivor's benefits, not only of the surviving spouse, but what do the kids get? Okay. And, if we have I don't know, let's say that we have somebody, the husband was, 62 when he passed away, or so I'll just make up some figures. 62, the wife was, 50, and the kids are both under 16. What type of benefit is she gonna get if he passes away? Well, she's gonna get a benefit because she's not going to get a benefit as a surviving spouse. She's not eligible for that until she's age 60. What she's going to get a benefit for is, as the survivor, she is taking care of a couple of kids or a couple of dependents that are under the age of 16, or she might be taking care of a dependent that is in the household and is that of a parent of the husband or something. Okay, so all those little scenarios you definitely want to be well aware of. The hold on one second. All right, cool. Yeah, the reduction in benefits, and we want to use, you got to know that that percentage reduction if we start taking before the full retirement age, what the quarters of coverage are, the 40 quarters and the 13 quarters. And I'm kind of glossing over this stuff because you guys are, not to freak you out, but you're about about 6 weeks away from the exam. It seems like a short period of time. Well, let me tell you, it's actually pretty decent amount of time that you guys have ahead of you for studying. And the reason I think that is the case is that you're, it may not be doubling your efforts at this point, but you're certainly starting to kick it into high gear. You probably started to ramp it up 2 months out, okay, or about 8 to 10 weeks out, which is great. And you're just going to accelerate, from here. So 6 weeks, you think about it, seems like a long time or a short period of time before exam. It is, but it also is not. All right. We also want to be paying attention to integration before we go any further too. I know one of you, and I can't remember, sent me a request to talk about margin, which is everybody's favorite topic. I'm going to explain it in a way that I hope that that will resonate. And then you can take that. Yeah. Hey, Luis.
Hey, quick question on the reduction in benefits. There's two kinds of reduction.
Yeah.
There's, reduction in terms of if you start taking it early, right? At age, before age 67. So that gets reduced, and that's a permanent reduction.
That's
and
correct.
Then there's also a reduction in terms of if you are still working and making an income, if it's above that 18,960.
Yes.
It gets your benefits get reduced $1 for every 2 that you earn.
Yes, it's a 1 for 2 reduction, $1 reduction for every 2 that you go over that roughly $19,000 figure. Yeah. And
there's also a 1 for 3 if you're getting close to the full retirement age.
Correct. Within that the year that you hit your full retirement age, then those months leading up to that, it's a $1 for every $3 over. It's a $1 reduction.
So but obviously that reduction stops the moment you start earning income.
Correct. Yes. So thank you for bringing that up, Luis, because here's how it works. All right, big picture is you're going to Social Security benefits will be reduced, one permanently, and the other one is going to be a temporary reduction. So if my full retirement age is 67 and I'm going to start taking benefits at age 62, you also have to know the formulas for that reduction. And I just can't keep them straight, but what you guys this is more top of mind probably for you, but one is like I believe the first 36 months, it's like a 5/12 reduction. And then in those months, 36 and beyond, 12, 24, 36, I believe it's a 5/12 reduction. Just double check my math on that. I'm pretty sure that's close. And then it's a 5/9 reduction. I'm pretty sure. Again, just double check on that for me. And if it's in the year, you're taking that in the year 4th and 5th years before your full retirement age. And I think we talked about it last week, and we just got to double check the math. But if you go in that 3 months prior to, let's say that you go like 36 months on the nose prior to full retirement age, you can take 36 and divide it by 180, and you'll see that you'll get a 20% reduction in your benefit. And that should come out to 5/12, just double check, times 36 months.
That's 5/9
yeah,
of
so
1%
I probably reduced it. Sorry?
It's 5/9 of 1% per month.
Yeah, and that's probably in the first 36 months. I probably
that's right.
Yeah, I flipped the numbers. That's why I said don't quote me on those, but I had the numbers right, but I had the reverse. 5/9 times 36, you see it comes out to 20% reduction. Okay, now just take 36 and then divide it by 180. You can't use this if the person is going earlier or is like more than 36 or earlier, later than 36, I guess, however you want to look at it. If the guy's taking us like 40 months early, you can use that 20% reduction, but then you got to flip to the 5/12. All right. So, but anyway, so the reductions are two. Here's a permanent one. Here's a permanent reduction. That's before, prior to 60, well, whatever the full retirement age. Okay. And then the other one, and, I don't think that they'll, well, who knows what they're going to do, but the other one is just a temporary reduction. Okay. And that is if you're still working, like Luis, like you were saying, you're still working and it's prior to your full retirement age, the Social Security Administration will temporarily, partially, so it's temporary and partial, or completely, spelling's off, but completely reduce your benefit. But what happens is that once you hit your full retirement age, and only good things happen from your full retirement age and onward, then what will happen is this temporary reduction in your benefit, and it may even have come down all the way to zero, that will be, basically that will boost your Social Security payments once you hit your full retirement age of, for example, age 67. So if you were going to get like $2,000 before, you'll get for the rest of your life, you'll make up for all that reduction. You'll get like $2,032 or something for the rest of your life. You're not going to have to calculate that. Just be aware that that's the thing. Or that's what's going to happen. Your integration, you definitely have to know Social Security integration. Let me explain that to you guys in so many words, or how this works out. The Social Security integration. Okay, let's say if we're talking about like a defined contribution plan, it'll be the easiest way to explain it, is that, do you remember we basically have like a covered compensation limit. So for this year, hold on one second, give me just 2 more seconds here, guys. Okay. So with our covered compensation limit, remember our Social Security taxable wage base. Okay, and that number is 142,800. And remember that, like, this is the number that the employer and the employee are contributing their OASDI portion to, or the old age portion of old age survivor and disability. So your FICA tax is what? It's 7.65%. And what comprises this 7.65%? It's old age, survivor, and a smaller portion, the disability insurance. Now, the old age portion of this, it's essentially 7.65 minus the Medicare tax. Okay, so it comes out to like 6.2%. And I know this is a confusing part. I will, just like other things, I either have or will have a video on this. But 6.2%, the employee and employer are paying 6.2% of 142,000 plus the other 1.45% from the employee and the employer, for a total of 7.65%. Now, once you get above this 142,800, the employer and the employee are not required to pay this, but they are required to pay this. Now, the idea with integration is that, well, I mean, if I've got employees that are making $30,000 and then I've got an executive making $1 million, $30,000 employees, I, as the employer, we're funding all of their income. We're funding half of their Social Security benefits based on all of their income. But the poor guy making $1 million a year, we're only contributing 6.2% of his salary or of his comp or whatever, up to 142.8. And, so the guy's kind of getting like the short end of the stick. We are going to kind of make up for that, and we're allowed to contribute to their a retirement plan, which we won't get into, but maybe like a non-qualified retirement plan. Well, we can contribute to that above this $142,800 mark, because again, above this amount, the employer is not contributing to that $1 million executive's retirement plan. Okay, so they're not required to do that. Okay, so that's how your integration, that's how your integration in a nutshell, how it works. You guys in this case, at integration, you have to become an expert in that. Okay, I think it's helpful if you guys know what's going on behind the scenes or the reasoning for it. I believe on your table G, they're going to give you the highly comped and key employee figures. All right. And so you have to know what a highly comp or a key employee is. And now, why do you have to know that? Well, let's say why do you have to know it? Well, because for the exam, it's not going to be it's not as cut and dry as just asking you a flat out question about, okay, well, is this woman a highly comped employee or is she a key employee? They kind of figure already know that. When I took the exam, and that was the longer, that was the 10-hour exam, they probably had more space to fill up. So maybe, I can't remember, but maybe they did ask us something like that, but they're not doing as much of those straightforward questions at all, or to a very small degree, I should say. All right. So you want to be familiar with your covered comp limits, your pension limits, right? Like I'm gonna be able to pull a pension benefit maximum of 235K, and then the maximum salary or comp that the employer can use to base the retirement benefit on that they're paying to everybody, let's say, or those that are eligible, is 290,000. Now, these two figures tend to get mixed up. Just keep this in mind. This is a pension plan limit, so that when we're if I want to plan for my retirement, I can basically like back into this number. I could tell the actuary, yeah, I want to set up some type of plan, just say like a defined benefit pension plan, and I want to get the maximum that's allowed by law. And the actuary will say, okay, well, that's 235,000. And so how much time do we have? 10 years. And how much do we have to fund this? You got to put away, whatever, $100,000 a year. Okay, done. That's what we're going to do. All right. Here on the 290K, that's our covered comp limit. So for my $1 million executive, okay, let's say that this guy's making $1 million, and as the employer, making a very generous 10% contribution across the board to all employees. So somebody making 30 grand, I'm going to dump 3 grand into their, profit sharing plan. And somebody making $1 million, I'm going to dump in $29,000. Well, why is that? Because this acts as a governor. This acts as a lid. This guy's making $1 million. He, maybe owns the company, or he's the top sales guy and owns the company. I don't know. It will be all day long. We want to contribute 10% of his income, but we're governed, or we have a limit on how much of our comp we can use to apply this 10% toward. Okay. So covered comp and your pension limits, make sure that you're aware of those. There are the various retirement plans that are out there. So you've got your defined benefit plan, you've got your target benefit plan, cash balance plan, and there's another one I missed. But there's basically, when you're thinking about your when you're thinking about your ERISA qualified plans, let's just put QP here. QP for our qualified plans, we're going to have 2 basic varieties, and somebody's coming in and giving me that plan. Money purchase. Yes, thank you very much, Gary. I appreciate that. I knew that was, it's in there, Gary. It just takes me a second sometimes, especially I'm trying to fit a lot of stuff in here. So with our qualified plan, just if you're struggling with this stuff, go back to the basics, look at the fundamentals. On your pension side, you've got your 4 pension plans. Okay, so let's put defined benefit. Let's put cash balance, target benefit, and then our money purchase. Okay, those are going to be our 4 types of pension plans. Now, all these plans are not guaranteeing that they're going to pay you like $5,000 a month when you retire, but they're making some type of guarantee. So pension is going to translate into a guarantee, whether we're going to pay you, based on your service here, we're going to pay you $5,000 for the rest of your life, whatever, or, we're going to set a target and try to hit that, or we're going to guarantee a rate of return. If we get more, that's great. But if we don't, okay, those things you want to key in and be very like expert level on your pensions. On the other side of your pensions, then you got your profit sharing plans. And there's like 11 of them. And you want to be very familiar with these profit sharing plans. So, what are your different profit sharing plans? You can put your 401k. You can put into this category. I actually have a cheat sheet on this, but I'm just trying to recall all of them. But there's like 11 of them. You might see like ESOP on there here. You guys could probably tell me a few more of these. They're just escaping me right now. But anyway, so pension and profit sharing plan are your 2 general categories, and you want to be familiar with all of the characteristics. Okay. Also, let's clear that out of there. And we want to key in on what type of plans are for business owners. You guys probably in your materials have something that shows us like a breakdown or a grid of all the different plans. Review that, keep reviewing it, and after you're done reviewing it, review it some more. And I'm not saying like 10 hours a day or anything like that, but you've got 6 weeks to go. You're going to casually review at least once a week, even if you think that you know it, what type of plans are beneficial for business owners, what type are beneficial, the most beneficial given a particular scenario. What if we've got somebody that's 2 business owners? One is, he's 30, and then his partner is, his business partner is like 60 years old. What kind of plan are we going to have there? We're going to have a target benefit plan. Will we have a new comparability plan? Okay, those are the things that we want to consider. Do we have an older employee or somebody that's way older than the average employee? Maybe we've got somebody that owns a college bar or something, and we know that there's a lot of turnover there for obvious reasons. The college students aren't going to be working at that bar very likely for much longer. They're there just for their college years. Is the bar owner 50? Is the bar owner 40 years old? Does that make a difference? Or do we want to have like a vesting schedule at all? If we do, or we're going to have to have a vesting schedule, but do we want like a, a plan that has a 3 or a 5-year cliff? Do we want 3 to 5 year graded, 3 to 7 years, or 2 to 6 graded? Okay, how does that plan fit the scenario? With the retirement plans, you're going to think about how the plan actually fits the scenario. And you'll be okay if you've got most of those basics down. Okay. We're going to do a calculation on maximum contributions. Just going to show you, one part of it, of how to do those calculations. And then let's talk briefly about IRAs. IRAs, you're going to know everything about IRAs that there is to know. There are some great resources out there too. So if you read like the Ed Slott stuff, and I'm sure he's got videos, but we certainly, most definitely got to know about your beneficiary and distribution rules, like big time. And if you've made after-tax contributions to an IRA and I take out a partial distribution, how is that going to be taxed? I would definitely have that down. Know everything there is about SEPs and simples, like all the rules here. It sounds like a lot. At this point, it really probably is not for you guys. But everything about SEPs and simples said, if I've got a simple as the employer, can I have another plan set up at the employer? No. But what's the contribution maximum if say the guy is working at I don't know, he's working at a dental office in the daytime, and then the nighttime he's working at a janitor at the local company or something, and both of these have a retirement plan. It's just that the dental office, like they often do, have a simple plan set up, and then at the place where he's a janitor, they've got a 401k set up. What's the maximum contribution? Okay, now the maximum contribution to a simple, we know it's 13,500. It's 19,500 to a profit sharing plan with the 401k. But if I've got access to both of those, not at the same employer, cannot do that. But if I've got access to both of these plans at the different employers, my max still remains 19,500. So I can do 13,500 to a simple, and then $6,000 to that 401k plan. IRA phase outs are important. I'll show you a brief example. Like the way that I look at it, and I know you guys have been taught one way, or you may have been taught this way too, but if you guys remember, what are our phase out limits for, let's say, somebody who is covered by an employer sponsored plan? Someone who's covered by an employer sponsored defined contribution plan is either making a contribution on her own, she's getting matching contributions or non-elective contributions, or she's getting forfeited dollars. Somebody left the company before they were fully vested, and the company has to use that to reduce expenses of the plan. And expenses of the plan obviously can mean the contributions that are required by the employer if they have such a plan set up. And so let's say somebody is covered by a plan. We have got a phase out range, and this is given to you on table G, but the phase out range is $105,000 to $125,000. And if my AGI is like 110,000, the way that, like I said, you have another way that you guys are thinking about this. The way I like to think about it is say, okay, well, all right, so she's earning $110,000. Here's the bottom end of this phase out range, and I like thinking about phase out range as like almost like a danger zone. This is an area that, or a zone that we get into, we're gonna kind of have some negative consequences. And so all I do is I look at the total amount of this range, which is $20,000. And I say, all right, well, she's making 110,000. She's $5,000. She's $5,000 into this $20,000 range. And just like last week, what was I saying last week with insurance? When you're doing any of these ratio questions, you always want to think about what is excluded. Pick one train of thought. If you want to think about what's included, that's totally fine too. I don't care. I just do it. I just think everything for me is what is excluded. Now this lady can do $6,000 to a traditional IRA, right? And she can contribute all day long. She just might not be able to deduct the whole $6,000. Okay, so just keep in mind that this is what we can put away. Elon Musk and Bill Gates, if they wanted to, they can put $6,000 into an IRA. Very likely that they're not going to be able to deduct that money, and I don't even know if they're going to be contributing this $6,000. It's just kind of a goofy example, but whatever. But look at what happens to her here. She's making the 110. She's entered into this like danger zone again, or this reduction zone by a matter of $5,000. Now 5 out of 20,000 is 25%. So what we are going to exclude is 25% of this number cannot be deducted if she indeed, deducts the whole $6,000. Or if she's 50 or over, or if she's 49 and will turn 50 this year, it's going to be 25% of $7,000 will not be allowed as a tax deduction. But she can certainly put in $6,000 or $7,000, whatever, up to the limit that she wants, and and all is well there. Okay, so that we're calculating, in a sense, this is an exclusion ratio. Now, what you guys are going to watch out for is, we've got a married couple, and they'll give you something like, it's the phase out range for somebody who is not covered by a plan. First of all, the phase out range for somebody who is not covered by a plan, in other words, the employer is not making contribution, they don't have access to a pension fund, nothing like that, is unlimited. Think of Elon Musk in that example. Okay, now if I'm pulling in a certain amount of money and my wife is pulling in a certain amount of money, okay, we are going to have two phase out range, all right, for ranges. And I'm not going to spend too much time on this because we have other topics to get to. But you want to be aware of the phase out range, which they give you on that table G, which for 2021 is 198 to 208,000 for a spouse who is married to somebody who is covered by a qualified retirement plan. All right, so watch out for like this sort of stuff where they give you, like I'm making 200,000. Okay, so I've entered into the danger zone, right? This danger zone is the spread of this is 10,000. Okay, so I'm making 200,000. How much can I how much can I deduct? 6,000 or 7,000, depending on my age. How much can I contribute? Excuse me, 6,000 or 7,000, depending on my age. How much can I deduct? Well, what portion, to what degree have I entered into this $10,000, phase out zone? And my wife is working and she's making, they could be sneaky about it. I'm making 200,000 and she's making, oh, look at this. What are the chances? She's making $197,000. What they're trying to lead you toward is that, yeah, like, in my case, I'm going to, for 20% of the contribution amount to an IRA, I just can't make, I have to exclude that as a deduction, or I can't deduct 20%. But my wife is basically making what I'm making, and they're going to try to trick you into, or at least try and do like a sleight of hand and make you think that, oh, well, she's under this 198, she can deduct the full amount. And that's not true, because then because she's covered by a plan, she's kind of limited, not kind of, but she is limited by this phase out range here. Okay, so phase out stuff, you got to definitely know that. All right, so I've thrown a lot at you, not too much, but any questions to up to this point? All right, the crowd goes silent, so that's usually, it's actually usually a good indication. Hold on, there we got a chat, and you guys can speak up too. You can chat if you're more comfortable that way. All right, let's see. Josh said, "Isn't the phase out chart included on the exam?" I'm pretty sure, Josh. I'm pretty sure that it is. I mean, I can actually picture it right now in my mind's eye, but you don't want to triple check on that. But I just checked and double checked for you. That phase out range is there. Now that trick though, you have to just be careful, because you're going through the exam questions. You're thinking to yourself, you got 2 minutes a question. By the way, I wouldn't be overly obsessed about the time on it. All right, you just figure, okay, I've got, let's say the first quarter of the exam, I've got an hour and a half. I want to get through these things. Let me get through the ones that I know pretty quickly. Let me get those the heck out of my way. Yeah, exactly, Gary. Thank you. Gary, you sure you want to add any more initials to your name? pretty soon, like your business card is going to start tipping that way, Gary. That's good. Congratulations, man. That's excellent. Rollover rules. Yeah. Hey, Killian, nice to see you. You got to know the rollover rules, and Killian and others specifically, or especially, I should say, Roth 401k rollover rules. You've got to dream about that stuff. That's how much you're going to know it down cold. You're going to know about distribution rules at the death. And I actually have that on the next slide. Someone who passed away, like beneficiary rules, distribution rules, 10% penalty on IRA distributions are mostly, and let me just stress, they're mostly the same as early withdrawal rules for IRAs are pretty much the same as early withdrawals from 401ks, but there are a few differences there. Make sure that you got those. You absolutely have to know those. Yeah, you need to know if we have somebody who is passed away who, was 73 and taking RMDs, but neglected to take the RMD before he passed away. We're going to want to know, is it beneficial? We've got a husband and wife, and the guy is 70. Actually, I can use my mom and dad in this example. Yeah, I'm going to try to recall the details here. It's not like I want to get in the family. I mean, I don't mind getting into the family stuff, but I'm trying to paint a picture for you as much as possible. So my dad passed, he was 80. My mom is 12 years younger. She was 68 when he passed. So let me see, that was in October. I don't think he took his RMD. I'm just trying to remember because I did all this stuff for my mom. I don't think he took his RMD for that year. So we took the RMD for him in the year of his death. You still have to do that. And then what we did is took his 401k and his IRA, because he would have had to take RMDs year after year. We moved those into my mom's IRA so that she can hold out until age, at that point, 70 and a half. Okay, and then the rules changed a couple years later. So they passed in 2016. The rules went into effect, I think 2018, with the age 72 RMD, or 2019, something like that. And so, that's a prime example of what the exam might ask you about. It's like, if we've got this large difference in age and the husband passes away and the wife is 10 or 12 years younger, is it more beneficial to move this money into an IRA, or should she, retitle it? Should she retitle that as a beneficiary, as the IRA or a spousal IRA? And why? What's the reason? Is she only 50? Does she need the money now? Then we're going to take a distribution from that inherited IRA. If she's comfortable financially and really doesn't want to take the RMDs because the guy is 20 years older than her, then we're going to roll it over, whatever. We're not worried about the 10% penalty. Okay, so scenarios like that, just be on the lookout for those. If I'm going a little bit too quickly, just throw a chat, or just chime in anytime. No big deal. Your coverage, you want to know your safe harbor, your ratio percentage test, the average benefits test. We're going to know those, especially this ratio percentage test. Take a little bit of time with it. If we have time left at the end of the night, I will go over that with you. Your qualified versus non-qualified plans, you want to have a good grasp of all of your non-qualified plans. Now, they're fairly straightforward, but what we do want to focus in on, and not a whole lot of time, a decent amount, but we want to know about our different income tax doctrines of, like, substantial risk of forfeiture, economic benefit, constructive receipt, how they tie together. Like, what's the story with a rabbi trust, and how is the rabbi trust, what does even substantial risk of forfeiture have to even do with a rabbi trust? Same thing, if we have some time, I'll come back to this rabbi trust. Just as a little note, if they happen to ask you, the 99% of the time, we're funding rabbi trust with a cash value life insurance policy, because once we get to about $13,000 of income generated by a trust, we're at the highest income tax bracket. And if I'm an employer setting this up for an executive, I don't want to pay corporate tax rates on either. I don't want to pay that corporate tax rates on the income generated by this trust. Now, how do we avoid that? Oh, we have a cash value life insurance policy. Why? That cash value life insurance policy acts as an IRA in the sense that we have tax deferred growth. All right, anyway, tends to trip you guys up. We might see an example of this. I don't know if we'll have the time, but anyway, is fairly straightforward. We're just focusing on the growth that occurs within a qualified plan while the employee is there, and what happens, when she leaves and she takes a full distribution. We might touch on that in tax. By the way, let's do tax next week. All right, let me give you an ADP test. I think a couple of you that were working that I'm helping out on the tutoring and have seen this test. So just bear with me for a second. Most of you have not seen this before. Even if you guys, for those of you who have seen this, it's a good review. We're going to read the last sentence first, and let's. Oh, by the way, ADP test, actual deferral percentage. Just let someone in. There we go. All right, let's look at this. Let's look at the last on ADP and ACP testing, and what it is, and how the testing works, and what's the maximum someone can contribute. They're going to probably ask you about that. So we want to know, what's the maximum amount that Cindy can save into her 401k plan in 2021 if the ADP of non-highly employees is 2%. What are they even talking about? What they're getting at here, what I think that they're getting at in this question, is we probably have someone here who's in a special category, and we are going to allow the employer, excuse me, to discriminate in her favor, but she is going to have a limit as far as the amount of discrimination that's allowed. So let's see what I mean by that. We've got Cindy, who's age 52. First of all, that's our first hint. Age, tax brackets, those two things in particular are very helpful to know about or to take note of. But anyway, so she's 52. She's bringing a couple $100,000 a year. Her employer sponsors a 401k plan and allocates all forfeitures to plan participants. Right. So this year, her employer is going to contribute 18% to all employees, and then they're also allocating $8,000 of the forfeiture to her profit sharing plan account. What's the maximum Cindy can save into her 401k in 2021 if the ADP of non-highly employees is 2%? They're telling me something here. I don't even know if this is going to play a part in our answer, but they might be telling me this for some reason. I probably want to pay attention to what's going on whenever I see a percentage sign. And all the rest of the stuff we'll figure out if it even makes sense to pay attention to it. But basically what they're getting at in this question is that we have somebody who is a highly comped employee, which we have to know, what the income level is. And again, if I'm not mistaken, I believe that's on our table G, that they give you the highly comped and key employee figures. And somebody's probably going to just confirm that with me. Oh, okay, it's somebody joining in. All right. But anyway, so let's look at this. All right, so let's look at this lady here. And when we get to ADP testing questions, let's just do this in 3 fairly simple steps. All right, keep it easy or keep it simple. First step, is she 50 or above? The answer is yes. If it's yes, let's go over here, just over here. And let's just know if it's in green here, she's putting it away. And exam tables do have the highly comped employees. Okay, cool. Thank you. GW. Highly comped. Yeah, look back to 2019 is 125. Look back to 2020 is 130. Thank you very much. Awesome. All right. Now, that's the first thing. So we make note of her age. Second thing that we want to now get into is I'm curious what her employer is putting away for her, because we're trying to back into a number, right? Like, how much can she actually put away on her own? And we're going to look at the $58,000. We're going to look at the $58,000 covered comp limit. All right, so we can go up to that. We can go up to that limit. Can't exceed it unless we're 50 and over. Okay, or annual additions. I think I said covered comp. The $58,000 annual additions limit. So we're going to say 58,000. And so what they want you to think is that, all right, well, if we're going to tell you that the employer and the employee, or if you know that the employer and employee combined can put away 58,000, if we just tell this person who's taking the exam that, that the employer is putting away like 50,000, we want the exam taker to think that she can put away 8,000. All right. But that's not the case. So let's see what the employer is putting away. They're doing 18% to all their income. It's 200,000. We're under the $285,000 limit. By the way, if she was making $1 million a year, we would take 18 grand times, not $1 million times, we do it times 285 grand. Okay, so now they're going to do 18 times 2 is 36,000. Let's just put that over here. And let's say employer contribution. How much is that? And then they're doing another 8,000. Now this guy, this guy's just kind of hanging out over here. We're not adding this yet. We're going to add this at the end because she can do 58 grand plus 6,500. Okay, it doesn't eat into this age 50 contribution, doesn't eat into the 58 annual additions limit. So let's look at what we have here. What is this? 44,000. Here's 44 grand. Okay, so here's what the exam wants you to think. They pretty much know that that the annual additions limit is 58,000. And they will give you, and you'll notice I didn't give you any answers here because I want you to think through it. You're going to maybe think like, oh, this is easy. She can do 14 grand. She can't. She's highly comped. So she has her hands tied by what? Well, these guys are putting away, the non-highly comp people are putting away 2% of their salary. Can we discriminate in her favor? Yes, but we have a limit. And you guys probably know this chart. If the non-highly comp workers are doing 0 to 2% on average of their compensation, saving away, then she can do whatever they're doing plus 2. Here's plus 2 right there. If you're doing between 2 and 8, excuse me, let me back that up for a second. And I know some of you caught that. This is times 2. This is, see, I think you guys thought you had me there. Not so fast, right? This is plus 2. And then if it's 8 and above, it's times 1.25. Now you don't have to, worry if we're on the border here or whatever. If ADP for non-highly comped is 2, it's going to be times 2, which is 4. Or if it's at 2, it's plus 2, that's 4. Or if it's 8, it's plus 2, that's 10. Or if it's 8 here, it's times 1.25, that gives us 10. Yeah, there we go. All right, Gary, you got it. Perfect. See, Gary, you're slightly faster than I was. But anyway, so that is going to be our, this is where she's going to be limited. So if it's 2%, ADP, actual deferral percentage of non-highly comp people, is 2%. It's going to be, pick whatever you want, 2 times 2 or 2 plus 2. For her, it'll be 4%. Now her income is 200 grand. So what she is going to put away is 2 times, I think I said 8,000 for a second. I was looking over here. She's going to do, 8,000, right? Because we've got 36,000 from the employer. We've got 8,000 that the employer is also putting away, for a maximum of 44,000. She and the employer combined. Now, at this point, the employer is done. Like they're putting this away, and that's it. There's nothing to indicate they're putting more away. But she's got what? She's got 14 grand left that she can put away. Just because she can put away doesn't mean she can do that, because her hands are tied here, or she's got a limit. They're putting away 2. She's going to put away 4% of 200 grand, which is 8,000. Okay, so that's the amount that she will be able to contribute, and that's what they're asking. What's the maximum that she can save into her 401k? It's 8 grand plus the age 50 catch up here, because they're just asking what's the maximum, and so she can put away a total of 14,500. Okay, any questions there? So ADP and ACP testing, make sure that you're familiar with the terminology, and more importantly, familiar with the math part of it. You do a question like this about 3 or 4 times, you'll be fine. All right, last one. Let's go over, because we had a request for margin. And we want to know, with a maintenance margin requirement of 35% and an initial margin requirement of 50%, which is fairly standard in the industry, at what price will, or at least the 50% part, at what price will Alina get a margin call? Now I'll make this pretty simple for you. Know the margin call formula here. 1 minus the initial margin percentage. Where do students get mixed up? Well, you get mixed up with, well, what's margin? Is it the debt or is it the equity? I don't understand. Margin is the equity. Okay, why do I say that? Because in a question, they might not give you 50%. They might give you 60%. And you have to know that that is the equity portion, because it's 1 minus the initial margin percentage. 1 minus margin equals equity. 1 minus 0.6, because they know that that you're so used to doing 1 minus 0.5, 1 minus 0.5. They throw in a initial margin requirement of 60%. You might do 1 minus 0.4. If you think margin is equal to debt, margin is equity. Okay. All right. 1 second. Let me let Jackie in. Cool, there we go. Okay, 1 minus maintenance initial margin requirement minus the maintenance margin. Why? Again, they want you to do 1 minus like 0.65. Okay, it's 1 minus 0.35. And you just, if they ask you something as straightforward as this, consider yourself lucky. We've got Alina here. that bought a stock. Now you can do this a couple different ways. I like thinking of it in the whole numbers. That's whatever, that's fine. And depending on the question, I'll just look at the stock price. They're just saying, how far does this thing have to fall before, you know, she's gonna, if it falls 1 penny more, before she gets a margin call. All right, so fairly simple in this one. You know, she bought 80 grand of stock for 40 bucks per share in her margin account. Okay, I added this, you know, or I included this in here because, you know, as a teaching example, she used 40,000 in her money market, plus she borrowed 40,000. Okay, now when they tell you that Alina has bought 80 grand of this stock and she's bought it on margin, and the initial margin requirement is 50%, you know that she put in 40 grand of her own money, cash or stock, whatever, it's equity, and then she borrowed the other 40,000. Okay, I mentioned that because you guys get sometimes confused on that part. Now the stock falls to $34.56. And I don't know, I just thought it was kind of entertaining to put in 3, 4, 5, 6. And then assuming a maintenance margin requirement of 35% and an initial margin of 50, at what price will she get a margin call? And, you know, so pretty straightforward on this one. If they ask you something like this, again, consider yourself lucky, because all you have to do is memorize the thing here. 1 minus 0.5 minus their maintenance margin. That's the margin equity. And we should come up with one minus our, what's our initial and maintenance. Oh, you know what? This is 1 minus, excuse me. 1 minus by 0.5. There's our 0.5 divided by 0.65. And we come up with 76.92%. So we just take her initial price of 40 grand times 76.92%. And when it gets down to $30 and like 37 cents, this is the point. If we go a penny under this, we get a margin call. Now, why do we get that? This is the point of, sometimes I think, a point of confusion, but let me clear it up for you. What happens is, in all of these margin questions, I need you guys to keep your eye. And again, some of you that for those of you I'm tutoring on this, because I know there are a handful of you here, you know that I tell you, do not take your eyes on this 40 grand. You owe that. You are going to have to pay that back. I don't care what that stock price does. You owe us 40 grand. We're the house. And those of you that know, I kind of like joke around and say, this is like a mafia thing. It's not going away. You owe that money. Forget about interest and taxes and all that stuff. Or forget about interest. You owe this 40,000. So to keep yourself grounded with this question, if you get into a jam and you're panicking a little bit because you got 2 minutes per question, then take 3 or 4 minutes on a high level tough question and figure it out using this 40,000 that she owes. And how are we going to actually do that? Well, the way that we're going to do that is looking at your margin questions in another way. Here's the alternate view. This is the question that you want to ask. At what point does the 40 grand that never goes away, you owe it until you pay it off, at what point does that 40,000 equal 65% of the total value of the position? I don't care, again, I don't care how far that stock price, well, we do care how much it goes down, but on an exam question, that's fine. You drop that stock price on me from 40 down to $25. I can then tell you how much money I have to dump in based on the fact that this does not go away. Do not take your eyes off of this. Okay, let's look at it this way. Here's the total value of the position times 65% is 40 grand. So what we're basically saying here is at what point of this total market value is that market value, the value of all those 2,000 shares that Alina bought, at what point is 65% of the value represented by the debt that I, as the brokerage house, lent you? And if I can answer that question, and if you can answer that question, you know that the other 35% is comprised of equity. Now the other way to look at it, we have to have at least 35% of the position market value, the total value of the position, represented by equity. And if it falls under that, we have to kick in more money so that, and what happens is that we're actually being forced to pay back this loan in part. Okay. So look at it this way, 40 grand divided by 0.65, right? This is kind of old school math. You take 40 grand divided by 0.65 equals $61,538. Now just do a little bit of math here. Our 61,500, this is the total position value, right? Divided by the 2,000 shares comes out to $30.77. Now, why did I do this right here? Because I wanted to show you, if you actually take your 61, let's just do a little experiment here, 61,538. Excuse me, do 40 grand divided by 61,538. Okay, now take 40 grand, divide it by 61,538, and you'll see that this 40,000 comprises 65% of the position value. That's what I mean by never take your eyes off of the debt. Let's see if we have actually an example here. Now that, that hopefully should help a little bit. If anything, let's take a look here. So yeah, 60, we have our debt. If you look at the rest of this position of the 61,538, okay, this is what happens when that stock price falls to $30.77, and we owe 40 grand on that. Okay, I should say $30.77. If we multiply it by 2,000 shares, that gives us 61,538. If 65% of that position is debt, that means the remaining 21,538 is of the position is comprised of equity. And in fact, if you take 21,538 and you divide it by 61,538, you'll find out that you come out to a perfect 35%. Okay. All right, so any questions on anything that we covered today? Retirement planning is, I believe I mentioned that when I was going through and studying for the exam, even though I was in a position of in the retirement, specifically in the retirement plan industry, like group retirement plan, I found that retirement actually gave me the toughest time, because who does testing? Not too many people professionally do testing. ADP and ACP and filing a 5,500. And that 5,500 is telling the IRS or the DOL, hey, I've got this many people and they're covered and all this other stuff. So let me see a question here. Sharon, what time did class start today? I think it was late. Yeah, that's okay, Sharon. I got it recorded. Later today, I'm going to pop it up on my YouTube channel. So, and Angie had sent out an email. If you missed it, no big deal. But we're starting at 7 from now on Central, just because of everyone out there, and a lot of you are from the East Coast, so I want to get you to bed at a reasonable hour. Jackie, is now 7 p.m. We're starting at Central. Okay, who knows, Jackie? Do I wound up in spam or something like that? Okay, but again, I've got the recording that I'll pop up here. It shouldn't take too long for it to upload and all that. Yes, please, Sharon. Yes, please do that. Okay. If you guys for next week, if you have, margin or ADP question, by the way, we're going to do tax. Let's do tax next week. Yeah, let's do tax next week, and then we'll do investments the week after. We'll start to wrap things up a little bit with estate planning. Let's tackle, let me see, how many weeks out are you guys? Basically 6 weeks out. So if we go tax next week, investments, estates, and then we can probably wrap things up with like a case study. That's 4 weeks out, because I think that ends us. Let me double check. I might be able to do 3 more weeks. I definitely know I can do 3 more weeks. It's that 4th week that 4th week of February, I don't know. So I'll basically keep you posted on that stuff. Yeah, sure. Non-qualified. Yeah, if you guys want to, let's go a few more minutes on non-qualified stock options and ISOs. I can wrap those up for you pretty easily. Let's start with ISOs in the first place. Now I think we talked about those in the second week, but let me just give you the kind of the rundown on ISOs incentive. This is why I wish that my PowerPoint didn't get erased, and why I don't like Microsoft sometimes, because they don't play well with Mac, although they've gotten a lot better. Okay, with ISOs, give me a second. Let's insert a new slide into here. New slide. And I'll just illustrate a couple of things. Now, with ISOs, what's happening? The employer is saying, look, Sharon, we appreciate you being here. We want to incentivize you to stick around. And what we're going to do is allow you to buy 1 share of our stock, whatever, it doesn't matter. Well, you can buy 1 share of our stock. Let's get rid of this stuff. Hold on. There we go, much better. You can buy 1 share. These are ISOs. You can buy 1 share of our stock at $5. And let me just check here. Please have me. Yes. So Jackie and Sharon. You guys were on there, but that's okay. Okay. And Jackie, that's your email. Just give me a second, everybody. All right. Here, instead of writing that down, can you guys email me? Just email me at info@proexamtutors. Yeah, just email and say, if you're not on the distribution list. I'll make sure to take care of you guys there. All right, let's do this ISO stuff here. It's actually not terrible, but they're going to give you the employer is going to give you the right to buy their company stock at $5. Now, when are you going to do this? Well, you're not going to do it at $5 because there's no discount there. You're going to do this when the stock price here, if we're looking at a chart, your stock price is doing this sort of thing. you know, and it starts to do this, and it's heading up. Okay, and it heads up to $12. That's at that point, you're like, look, I'm actually gonna exercise this incentive stock option. And so the stock is the stock is fair market value is at 12. I get to buy this thing at 5. All right, now in the back of our minds, we're going to keep in mind that we have something called the bargain element, and that is equal to $7. It's the difference between the fair market value and $5. It's the discount that I get on this thing. All right, so now we got this bargain element of 7. And if I want this to be a qualified transaction, what I'm going to do is wait. So I bought this thing, right? But we're going to wait. I'm going to wait more than 1 year from the exercise, and I'm going to wait. And so this is not an or deal here. That's at more than 1 year after the exercise and more than 1 year after the grant to sell this thing. And if I wait for more than 1 year after I exercise and 2 years after the grant, remember a couple weeks ago I mentioned, how do you keep is it grant and exercise? Is it exercise and grant? If you think about it, it should make sense. But if you don't want to think about it too much, which I don't blame you, in the alphabet, we get to E first. We get to G second. All right, so just as kind of easy as that. Let's let carry in. Okay. So now if I satisfy those two conditions, then what happens when this thing goes up to like whatever, $20? It goes up to $20. The whole thing from $5 where I bought it all the way up to 20 is going to be a long-term capital gain, because I wait. In that point, it's a qualified stock option because I waited for more than 1 year after the exercise and 2 years after the grant to sell this thing that I bought at 5. And this bargain element of $7, it's all long-term capital gain as well. If I make a disqualifying disposition of this, if I don't satisfy these two holding periods, then what happens is that the $7 is treated as ordinary income tax. And I don't want that to happen, because if I'm given ISOs, I'm probably making a good deal of money, and I might be in a higher tax bracket, and I want to take advantage of long-term capital gain. Cool. All right, Jackie, you sent me an email. Appreciate that. Awesome. Okay. That's on the ISO side. On the non-qualified stock option side, there's really, not much to it other than, what we're going to do is, at $5, we're going to give you the right to buy the stock. The stock goes up to $12. And we just have to be mindful here of this $7 bargain element. And the big thing is, like, for the ISOs, when I actually exercise the option, given these same figures, I didn't have a taxable consequence there. There was no income tax, no FICA taxes, nothing like that. On the non-qualified stock option side, this bargain element, when I go and exercise this, I don't have a 1 and 2 year holding period, by the way. When this happens, this is considered W-2 income. So I'll have FICA and all that stuff. All right. Now, if I wait for more than 1 year after I actually buy this thing, like the big benefit to a non-qualified stock option is that I actually just get to buy this company stock at 5. I do have to pay income tax on this bargain element. Okay, but once I, pay the income tax, what happens is my basis actually gets kicked up to $12. And anytime I sell this thing for more than 1 year after I've exercised, all long-term capital gain. And that's kind of name of the game. Keeping the taxes as low as possible. Okay, I think that does it for today. So I definitely appreciate all of you attending our Monday night group. We're going to meet up again. As I mentioned, we're going to meet up again next week. And we'll do taxes next week. Same thing. Send me any topics or questions that you have questions about. If I don't get any requests, that's fine. I'm gonna cherry pick some topics like I've been doing every week that we can go over that I think are more on the difficult end, or that I know are on the more difficult end for you guys, and that I think that have a higher likelihood of being tested on the lovely CFP board exam. All right, so yeah, Killian, you need a cigarette. Okay, hey, whatever you got to do, man. Whatever, nicotine makes you think faster. So yeah, Sharon, give me about an hour for that recording to pop up, maybe not even that long. Yeah, Carolyn, no, I got you. And Carolyn, I'm gonna update my slides. A handful of you guys have asked. I got to update my slides. The last one's got they got, which doesn't happen too often, but they got erased somehow. Yep, Rhonda, you got it. You're welcome. I appreciate it. To to the odd ones like me, I think this stuff is interesting, and helping you guys is fun too. So it's all good. But yeah, Killian, you're in rough waters, man. You quit coffee for a day. But you know what? Like I said, if you need to step out for a smoke, no problem. All right, Andrew, you got it. My pleasure. I'm gonna sign out. Give me a little bit of time for the slides and the popping the YouTube or popping the video up on my channel, and let's go for 100% pass rate on this exam. Okay, so that's the story there. All right, good night, everybody. I'll see you guys actually on next Monday, 7 p.m. Central. Talk to you guys then. Bye.